If your CPA told you you have 30 days to reinvest after a real estate closing or you're going to owe taxes, I need you to hear this. That's not a real deadline. The panic you felt after closing, unnecessary. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay zero to little taxes using my zero tax blueprint. I want to tell you about a conversation I hear all the time. Someone closes on a real estate deal, a rental property they've held for years, a piece of land, a property that's being renovated. They made money and they're excited. And then they call their CPA. And the CPA says, you've got 30 days to reinvest that money into another property or you're going to owe taxes on it. And just like that, the excitement is gone. Now you're stressed. You've got a clock running. You're scrambling to find a real estate deal that makes sense in a time frame that doesn't make sense. Maybe you find something and rush in, and it's not the right property, but you do it anyway because you think you have to. Or maybe the 30 days pass and you didn't find anything, and now you feel like you just blew it, like you left money on the table that you can never get back. I have talked to investors who made a bad property decision because they felt that pressure. And I've talked to investors who did nothing and spent months feeling like they failed, when the truth is they didn't fail at all. Because here's the thing, that 30-day rule is not in the tax code. It does not exist. And the conversation your CPA was really trying to have with you, it's actually a much better conversation than the one you got. Let me give you the full picture. Before I go any further, I want to be really clear about something. I'm not here to throw your CPA under the bus. The vast majority of CPAs are hardworking, knowledgeable professionals who generally want to help their clients. But real estate investor tax strategy is a specialty, and not every CPA lives in that world every day. When someone is trying to give quick, practical guidance to a client who just closed a deal, sometimes that nuance gets compressed. What you heard as 30 days was probably a shorthand version of something much more layered. There are real rules in the tax code that involve reinvestment and time windows, and they sound a little like what you were told, which is probably where the confusion starts. The most well-known one is the 1031 exchange. Under IRC Section 1031, if you sell an investment property and reinvest the proceeds through a qualified intermediary into a like-kind replacement property, you can defer your capital gains taxes. There are timelines, 45 days to identify a replacement property, 180 days to close, but a 1031 exchange is a very specific, structured process. It has to be set up before closing. You can't decide to do one after the fact, and it doesn't make the taxes disappear. It defers them into the next property. Please take a look at my videos on the 1031 exchange. There's also the memory of an old primary residence rule that was replaced back in 1997, where you used to have to reinvest your home proceeds in order to avoid taxes. That rule is long gone, but it's still floating, I think, around in a lot of people's heads. Neither of these is a 30-day blanket rule, and neither one is what most investors actually need to be focused on. Here's why this matters beyond being wrong information. The 30-day myth does something really damaging to investors. It turns tax planning into an emergency. And when you're making investment decisions in emergency mode, you're not making good decisions. Think about what that pressure actually looks like in real life. You close on a sale, say in early October. Your CPA tells you you've got 30 days. Now you're looking at properties not through the lens of, is this a good investment? You're looking through the lens of, can I close this in time? You skip due diligence steps you wouldn't normally skip. You offer more than you should because you're running out of time. Or you find a property that's just okay and you convince yourself it's fine because the alternative feels worse. That is a bad framework for building a real estate portfolio. And on the other side, the investors who couldn't make it work in 30 days, who didn't find the right deal, or didn't have the financing lined up, or just couldn't get it done. And more than that, they didn't do anything later in the year. They walk away feeling like they made a mistake, like they owe every dollar of that tax because they didn't move fast enough. That guilt and that feeling of missed opportunity, it's based on a rule that doesn't exist. I want to give you something better than that. Here's what actually matters. And once you understand this, it changes the way you think about everything. Your tax return is a full calendar year, January 1st through December 31st. That is your planning window. Not 30 days from your closing date, not 45 days, not 90 days, the entire year. When you sell a property in March and generate a taxable gain, that gain sits on your return alongside every other financial decision you make between that day and December 31st. A deduction you create in November directly offsets income you created in March. The IRS doesn't separate them by transaction or by date. It looks at the whole year as one picture. This is the foundation of real tax planning, and it's generally good news for real estate investors because it means you have time, real time to think strategically, to find the right deal, to make decisions that are good for your portfolio and your tax situation, not one or the other. Now, let's talk about what you can actually do briefly inside that window. Number one, bonus depreciation on a new property purchase. So if you sold a property in the spring and generated a $70,000 gain, and later in the year you purchase a rental and generate $65,000 in bonus depreciation through cost segregation, you've just offset almost that entire gain legally, using the tax code exactly as it was designed to be used. Please go back and watch my videos on bonus depreciation and cost segregation for more in-depth information on this topic. Number two, reviewing your entity structure. How your real estate activity is structured affects how every dollar of income gets taxed. Are you running the right entity for the volume and the type of deals you're doing? Are you taking advantage of strategies like S-corp treatment to reduce self-employment tax where it applies? Entity decisions aren't something you set once and forget. They should be revisited as your portfolio grows and your income changes. And they're most powerful when you look at them proactively, mid-year, not in April after the year has already closed. You can find more information on my prior video about entity structure. Number three, one of the most underrated planning tools is simply when you do things. Can you time a closing to fall in a lower income year? Can you accelerate a deduction expense into this tax year? Can you structure a sale as an installment sale and spread the gain across multiple years? None of these are available to you if the first time you look at your tax picture is April 15th. So what this really comes down to, the 30-day rule puts you on defense. It makes you feel like time is running out, like you're behind, like every decision has to happen right now or the opportunity is gone. Real tax planning puts you on offense. It says, I know what my picture looks like. I know what tools are available to me, and I have the rest of this calendar year to make smart, intentional moves that change my outcome. The investors who consistently keep more of their money aren't the ones who found a shortcut after closing. They're the ones having a real conversation with a qualified advisor, ideally before the sale closes, and definitely not just once a year in tax season. They're asking, given everything happening in my portfolio this year, what should I be doing between now and December 31st? That is the conversation that builds wealth over time, and you deserve to be having it. If you've been told the 30-day rule, or honestly felt that panic after closing because you thought the clock was running, I want to hear about it in the comments. Tell me what you were told and what you ended up doing. I read all of them, and those comments are often how I decide what to make next. Because if you heard it, someone else did too. If this was helpful, hit subscribe. This is the kind of content I put out. Real specific tax strategy for real estate investors who want to understand what's actually going on with their money, not just taking someone's word for it. I'll see you in the next one.